Welcome to Subramani. I've made many videos on diversification. Now today I'm going to talk to you about what are the asset classes across which you could diversify. If you are a real rich person, ultra rich, dealing in thousands of crores, not even hundreds of crores, there are various asset classes that you can do. You can invest in horses, you can invest in oil wells, you can invest in big chunks of commodity. All those things you can invest, but I'm not talking of that level of diversification. I'm looking at the more modest 20 crore 30 crore kind of a person's portfolio, apart from the 20-30 lakh kind of a portfolio, right? Not beyond that people will know what to do on their own, and this is not addressing them at all. So first is equity. Equity, you need to enhance returns. There is absolutely no doubt, because just preserving capital is not part of what we want to do. We want to improve the returns in such a way that we will be able to do nothing, or be able to do what we want to do at a time when we are younger. So obviously there has to be equity in your portfolio. Equity also, you need to remember that there is nothing called just equity. So there is Indian equity, there is Japanese equity, there is Chinese, there is US, right? US is 66% of world equity or market cap. So you cannot ignore the US market. You have to invest in the US market. Of course, in India today you have funds available which invest across internationally, but there are some restrictions on by SEBI. So equity, diversified equity, which could be mid cap, small cap, flexi cap, large cap, whatever, all those things across geographies, all that is equity. Equity is the highest risk class, especially in the short run. In the short run it could fluctuate. However, if this is money which you can afford to lose, you will not make a loss, but the mind should be willing to accept that if there is a loss, you will not worry about it. You will invest continuously in that, which means you will do an SIP. And you will do an SIP for a longish period. Your thinking should be 30-year, 40-year kind of a thing. Maybe in 10 years it was done extremely well. You can remove some money. I'm not saying you can't remove money, but that should be the view of investing across equity. Next, of course, is bonds. Bonds, you can lend. Bonds is a way of lending money. You could lend money to the government, which is called gilt. You could lend money to corporate India, which will pay a rate less than what the government will pay you. So if the government is paying you 7.25, chances are a good corporate will pay you something like 8.5, 9, or maybe 9.25. At least 200 basis point difference you want. Why would you put your money in, say, Cholamandalam Finance or a Tata Finance at anything less than 10 when gilt itself is at 7? Maybe you will compromise to 9.25, but you won't go much below that, because gilt itself is the base for which you price. That by doing this you are diversifying across risk, right? You're saying, okay, I will put in government, I will put in some AAA companies, I'll put in some AA companies, I'll put in some A companies where I know things can go wrong and I might lose money. So, but why am I doing that? To enhance the total overall portfolio return. However, whatever I want to do, I will not put more than 15% in AA or something like that. All others will be in much higher quality of debt. Here you are not compromising on debt. However, suppose you have gilt which is 30 years, and you can't put all your money into a gilt fund. So you will diversify across duration. You will put some money in something like a liquid fund or a money market fund, which you can withdraw. You withdraw within a day, and you will not find any fluctuation. These are funds where the NAV will very, very rarely go negative. Every day your portfolio will go up by a few paise or a few rupees, depending on the amount of money that you have kept. Very, very little risk, but of course risk of inflation. On the other end of the spectrum is government bonds, which would be 30-year bonds. You could invest either in bonds or you could invest in a bond fund. A gilt fund is a bond fund with which owns government securities. So this is the second one. So first you have equity, second you have bonds, third, of course, you could have gold. Gold is as an asset class, many people have been investing for just donkey's years. 4,000 years ago, 2,000 years ago, 3,000 years ago, you still find mention of gold. Compared to that, equity is a recent phenomena. It is only maybe 250 years old or 300 years old, even if you take the US. India, of course, had a very primitive stock market. I wouldn't consider it so much as primitive, but the white man came and told us it's primitive, so we believed it was primitive, though some of those practices are still much better than current days practices. But sorry, I'm digressing. So yeah, gold could be another asset class in which you could invest. Then of course there is cash. People don't see cash as an asset class. Cash is a very, very important asset class. It is what people call the waiting asset class. If you don't know where to put, do you want to put money in equity or debt or gold, you're not sure, or you think everything is overpriced, that's a time when you should be in cash. So in this case, cash is not just meant for your day-to-day expenses. It is a strategic decision to stay on in cash. Yes, the current return that you get in cash may not be very high, but do remember, when interest rates go down, when interest rates go down, your portfolio value will go up, but after some time the interest rate will start going up and your portfolio value will go down. So you will have to be careful as to timing the bond market. Bond market timing is very important. In equity, you can wait. You missed one cycle, you can always sell in the next cycle. So those things in equity you can do. In debt, it is very difficult to do. Then of course there are other alternative investments. You have AIF, you have PMS, but PMS and AIF, mutual. Why have I not mentioned mutual funds here as an asset class? Because mutual funds are not an asset class. It is just a cloak that you are giving for some assets to be kept under that. It is just a covering, just a pipeline, whatever you want to call it. It is not an asset class in itself. So you could invest in mutual fund, which is investing only in gold. So therefore you have that's also a mutual fund, investing only in equity, investing only in debt, or investing in multi-assets. It invests in India, it invests abroad, it invests in bond, it invests in gold, and it has cash, right? So you have that multi-asset approach in one fund. So what did the people say? Largely diversification, how have people approached it? First of all is the 60-40 American formula, where you put 60% of your money in equity and 40% in debt. This sounded good before perhaps 1980, but 1980 to 2022, the market saw a huge fall in debt, in interest rates. Therefore the portfolio went up. But if you invested sometime late in the cycle, maybe 2001, 2002, you have seen tremendous erosion in value. So that does happen. So 60% of your money is in equity and 40% is in bonds. Here he just says equity. He does not say equity mutual fund or direct equity. So that's a call that you have to take. So when you put money in a mutual fund which invests in equity, treat it as equity. When you invest in a mutual fund which invests in debt, treat it as debt. When you invest in an asset which is a multi-asset fund, treat it as a multi-asset. It has got gold, it has got foreign equity, it has got Indian equity, it has got all of that, right? So Warren Buffett, I think, has told his wife that, I think it is there in his 2013 letter to Berkshire Hathaway. He says 10% you put in short-term government bonds, something like in India the ultra short bond fund or the short bond fund, and 90% in a index tracker. This is Buffett's way of saying how you should diversify. I think it is a little emphasizing on equity, which looks very good now because we have been through a big bull run and we have constantly in a bull run. So this sounds good, but when the market comes down, this will sound very risky, right? So, but yeah, this is what Buffett says. I'm not getting into right or wrong, but this is what Buffett says. Then there is of course, the first one we spoke about is 60-40. That is the American way of saying, okay, 60% should be in bonds, 60% should be in shares and 40% should be in bonds. There is of course a slight different version that you put in bonds as much as your age is. So when you're 25, you put 25% in bonds. When you're 90, you put 90% in bonds. Of course, they don't have a solution for 110, so be prepared for that. Then there is the Ray Dalio's all-weather portfolio. I like Ray Dalio's all-weather portfolio. It says long-term US bonds are 40% in his portfolio. That's what he says. And then he's got US stocks worth 30%. Then he's got international bonds, right? Interest bearing US bonds or whatever. He's got, so the international for him would mean anything outside of US. Then he's got gold, he's got commodities. Now this looks like a good portfolio, but there is just too much in bonds, and that overall return may not be too good. So this is Ray Dalio's all-weather fund, as he calls it, right? Then there is Harry Brown's permanent portfolio. He says once you are into such a well diversified portfolio, you may not have to touch it at all, you may not have to do anything. But I completely agree with Harry Brown, because I'm in that category where I don't need to touch my portfolio and my dividend will take care of my expenses. So I don't need to, but there will always be some tinkering. Harry Brown says the long-term US bond should be 25%. Gold should be 25%. This is very high. You rarely find fund managers saying so much should be invested in gold. US stocks 25% and US treasury bills 25%. The problem with all these people who have created these perfect portfolios and great portfolios have completely ignored that for a very long period of time the US market did nothing. What do you do in such a case? Then there is the barbell strategy. How we do stock invest, how do we analyze how to invest in our money. We like to invest, especially if you like to invest in individual stocks, you have to put an overall limit how much you will put in individual stocks, how much of concentration and how much of lack of skill or not having enough back office to be able to manage it. All this put together gives you the picture of how well you should be diversified, if you are to be diversified at all. Thank you.